The LLC is the most talked about financial tool for anyone building their first 100,000. It is also the most misunderstood. The majority of people who form one, and there are millions of them, get either none of the protection they paid for or a tax bill that looks identical to the one they had before. Today we take it apart, piece by piece, and find out exactly what it does, what it does not do, and whether you need one yet. An LLC has two jobs that people confuse into one. The first job is asset protection, building a legal wall between you and your business so that if the business is sued, your personal savings are not on the table. The second job, which only kicks in under specific conditions, is tax reduction. Most people who form an LLC get the first job halfway right and the second job completely backwards. By the end of this, you will know exactly how each mechanism works, when it applies, and what you actually have to do to activate it. One clarification before we open the evidence locker. An LLC is not a tax loophole. It is not a magic word that transforms your income. It is a legal vessel, a container your business lives inside, separate from you, so that the business's debts and legal problems cannot automatically become yours. Understanding it as a vessel rather than a trick is the difference between using it correctly and paying a state filing fee for nothing. The game is afoot. Exhibit A, the liability shield. Without any business entity, you and your business are legally the same person. A customer slips and falls in your shop, they can sue you. A vendor you owe money to, they can come after your savings. An angry client over a freelance dispute, your car, your bank account, your future earnings are all in the territory. The LLC's first job is to draw a line between the business, which can be sued, and you, whose personal assets are behind the line. The shield, however, has specific gaps. If you personally guarantee a business loan, which most banks require from new businesses, the shield does not cover that debt. If you commit fraud or cause harm through your own deliberate actions, no entity protects you. If you withhold payroll taxes from employees and do not remit them, that liability follows you personally regardless of any structure. And critically, as we will examine in a moment, the shield can be made completely void if you do not maintain the LLC properly. Exhibit B, taxation. Here is where most of the confusion lies. By default, a single-member LLC, which is what most individuals form, is what the IRS calls a disregarded entity. This means the LLC itself pays no taxes. The income flows straight through to your personal return on Schedule C, exactly as it would if you had never formed the LLC at all. The LLC, on its own, changes nothing about how you are taxed, and this surprises an enormous number of people who expected otherwise. And the specific tax that makes this matter is self-employment tax. When you earn income through a business, as a freelancer, a consultant, a sole proprietor, or a default LLC, you owe self-employment tax on every dollar of net profit. Currently 15.3% on income up to roughly $176,000, then 2.9% above that. This covers Social Security and Medicare, the same taxes a salaried employee splits with an employer. As a self-employed person, you pay both sides yourself. On $50,000 of profit, that is over $7,000 before income tax. Exhibit C, the S-corp election. This is the mechanism that actually affects how much self-employment tax you pay, and it is not automatic. To access it, you file Form 2553 with the IRS to elect S-corporation tax treatment for your LLC. Once you have done that, you split your business income into two buckets. The first, your salary, wages you pay yourself as an employee of your own company, on which you do pay payroll taxes. The second bucket is a distribution, profit taken above and beyond your salary, on which you do not pay self-employment tax. Only the salary portion is subject to it. The question that follows is, at what point does this save more than it costs? Because an S-corp election is not free. You must run actual payroll, filing quarterly, generating a W-2. Payroll services cost $500 to $2,000 a year. The IRS also requires the salary to be reasonable, meaning You cannot pay yourself $10 and take the rest as distributions. That is the first thing they look for on audit. The general rule, confirmed by most CPAs, is that the S-corp election starts making sense somewhere around $40,000 to $50,000 of annual net profit. Below that, the compliance cost can exceed the tax saving. Which brings the question most people are actually asking, do you need an LLC yet? And the honest answer for many people watching this is not yet, and that is not a failure. If your side income is below $20,000 a year, your liability risk is low, and you are operating as a freelancer or consultant. A sole proprietorship costs nothing to maintain and taxes identically to a default LLC. The moment an LLC becomes worth its administrative weight is when either your liability risk becomes real, serving clients who could sue you, carrying inventory, hiring people, or your profit is high enough that the S-corp election saves more than it costs. When you are ready, formation is simpler than it sounds. Step 1. File articles of organization with your state's Secretary of State. Most states handle it online, and fees range from $50 to $500. California adds an $800 minimum annual franchise tax, which is why some California residents form their LLCs in Wyoming or Delaware, though that approach has its own costs and trade-offs. Step 2. Obtain an EIN from the IRS at irs.gov. It is free and takes 15 minutes. Step 3. Write an operating agreement. Who owns what, how decisions are made, how profits are divided. Some states require it. All states benefit from it. Every state requires a registered agent, a person or company with a physical address in the state, available during business hours to receive legal documents on your LLC's behalf. You can be your own registered agent if you have a physical address in that state. If not, commercial services cost $50 to $300 a year, a recurring cost most formation guides undercount. Now we arrive at the single most important thing I can tell you about operating an LLC. Open a separate business bank account and never mix business and personal money. Not once, not for convenience. Every time you pay a personal expense from the business account or deposit business income into your personal account, you are committing what lawyers call commingling of funds. Commingling is the primary mechanism by which courts throw out the liability shield entirely and allow plaintiffs to reach your personal assets. Separation is not a nice to have. It is the whole foundation. The legal doctrine that destroys the shield is called piercing the corporate veil. A court can look through the LLC as if it does not exist and hold you personally liable when you have treated it as a personal piggy bank. Commingling funds is the most common cause, running personal errands on the business card, taking money out without documentation. These are the clues a plaintiff's attorney looks for in discovery. The LLC is a vessel. Maintaining it as a separate vessel with its own accounts, its own records, its own transactions is what keeps the hull watertight. Beyond the bank account, the ongoing maintenance an LLC requires is modest but non-negotiable. Most states require an annual report, a form confirming the LLC still exists. Fees range from $25 to $200. Missing the due date can result in the LLC being administratively dissolved, which is exactly as inconvenient as it sounds. Know your state's requirements. Set a calendar reminder. So here is the verdict. The LLC is a real tool with a specific, valuable job, separating your personal assets from the legal and financial consequences of your business. It does that job well, provided you maintain it correctly. The S-corp election is a second, separate tool that reduces self-employment tax when your profit is substantial enough to justify the compliance cost, typically above $40,000 to $50,000 of annual net income. Neither is a shortcut. Both are structural decisions that become more powerful as the numbers grow. The vessel is only as useful as the care you put into keeping it seaworthy. And here is where this sits on the road to 100,000. The LLC is infrastructure, not income. It does not earn you anything. It protects what you earn, and at a certain scale, it reduces what you pay. Most people building toward their first 100,000 do not yet need the S-corp election, but they may well need the liability shield, particularly if they are running a real business with real clients. Build the vessel when the contents are worth protecting, not before, not much after, and read the whole map, not just the headline. Tell me in the comments, have you formed an LLC and did it do what you expected? I read everyone. If this case gave you clarity, subscribe and sail with the crew. Next case, your freedom number. Not the first 100,000, not any salary, the specific figure that buys your financial independence outright, and how to find yours. Until then, keep your ledger honest and your cutlass sharp. The game is afoot. Deduce your way to treasure.